When we think about tracking the Indian stock market, the Nifty immediately comes to mind, right? It gives you that quick pulse check.
Exactly.
Well, over in the US, the Dow Jones Industrial Average plays, a similar role, although it's much older.
Much older.
And frankly, what happens in the US economy doesn't just stay there. It sends ripples everywhere. It impacts revenues for companies all over the world, maybe even informs, your own investment choices if you're looking at global markets or companies serving the US.
Absolutely. Think about our own IT sector here.
Right. Their fortunes can really hinge on how the US market is doing.
Definitely.
So for this deep dive, our mission is pretty clear. Let's really get under the hood of the Dow Jones Industrial Average. We'll look at
Oh.
what it actually is, its history, which is
hmm
pretty interesting how it's calculated, which is not as simple as you might think,
Not at all.
and also how you can invest in it, and critically, what its limitations are. What doesn't it tell us? Okay, so let's start right there. What exactly is the Dow Jones Industrial Average?
So at its core, it's an index. Its job is to give you a kind of snapshot of how 30 of the biggest, most influential public companies in the U.S. are doing.
Just 30.
Just 30. But these are major players traded on exchanges like NASDAQ and the New York Stock Exchange. You often hear people call it the Dow 30, or sometimes just the Dow Jones Index.
Okay.
And the folks who manage it, who pick the companies and handle the numbers, that's S&P Dow Jones Indices. It's actually a joint venture involving S&P Global.
Right, S&P. Now, I said it feels old. Just how old are we talking?
We're talking really old in market terms. It dates all the way back to 1896.
Wow, 1896?
Yeah, created by Charles Dow and Edward Jones.
Yep.
So it's genuinely one of the oldest continuous market indicators anywhere in the world.
Okay.
And back then, it was even smaller, just 12 stocks initially. And looking at that list gives you a real flavor of the U.S. economy back then.
What kind of companies?
The gas, sugar, tobacco, railroads, oil. Those are the industrial powerhouses of the late 19th century.
Railroads and sugar. That really paints a picture.
Yeah.
So different from today's tech giants. How did it get from 12 to the 30 we know now?
Well, as the U.S. economy grew and changed, especially in the early 20th century, the index needed to reflect that.
Yeah.
So in 1916, it expanded to 20 stocks.
Okay.
Then in 1928, it reached the 30 stock level it still has today. That shift kind of mirrored the broadening of American industry.
Makes sense.
And importantly, that list of 30 isn't set in stone. It's changed over the years.
Yeah.
Major economic upheavals like the Great Depression in the 30s or the 2007-08 financial crisis, those often led to changes. Companies might fail or merge or just not be representative of the leading edge anymore, so they get swapped out.
Right, it has to evolve. Okay, so we know what it is and a bit about its history, but the calculation, that's always seemed a bit mysterious. It's not just adding up the prices and dividing by 30, is it?
No, you're absolutely right. That's a common misconception. Many indices you hear about, like the S&P 500, are market cap weighted. They look at the total value of all a company's shares. The Dow is different. It's a price-weighted index.
Price-weighted, what does that mean in practice?
It means the index level is basically derived from the average of the share prices of those 30 companies. But like you guessed, it got more complicated than just summing and dividing by 30 pretty quickly.
Why? What was the problem?
Well, think about a stock split. Let's say a $100 stock splits 2 for 1. Suddenly, it's trading at $50.
Right, but the company's value hasn't actually changed.
Exactly. But if you were using a simple average, that $50 drop in one stock's price would pull the whole index down artificially. It wouldn't reflect the real market trend. Mergers, spin-offs, things like that cause similar issues.
Ah, I see. So you need a way to smooth those things out.
Precisely. And that's where something called the Dow divisor comes in.
The Dow divisor. Okay, this sounds like the secret sauce. How does that work?
So instead of always dividing the sum of the 30 stock prices by 30, they divide by this special number, the Dow divisor. And this divisor gets adjusted whenever something structural happens to one of the component stocks, like a split, or sometimes even a large special dividend, or when a company is added or removed.
Okay.
The whole point is to make sure those kinds of technical changes don't create misleading jumps or falls in the index value itself. It maintains historical continuity.
So the divisor changes over time.
Oh, absolutely. It's not fixed at all. Back when it started with 12 stocks, the divisor was, 12.
Yeah.
Simple enough.
Right.
By 1928, with 30 stocks, it was about 16.67. But jump ahead to, say, 2019, and it was way down around 0.147. And in early 2023, it was roughly 0.1492.
Wow, less than one.
Yeah, it shows how many adjustments have happened over the decades. Splits primarily push the divisor down, it really underlines that the calculation is dynamic.
Okay, so back to this price weighting thing. If it's based on the share price, does that mean a company with a, say, $300 share price has more sway over the Dow's movement than a company with a $50 share price, even if the $50 company is actually much bigger overall?
That's exactly the implication. A $1 change in that $300 stock will move the Dow index significantly more than a $1 change in the $50 stock.
Huh.
So effectively, the companies with the highest share prices have the biggest influence on the index's day-to-day movements, regardless of their total market value or, arguably, their overall economic importance.
Yeah.
That's a really fundamental aspect of the Dow.
And probably a key limitation, I'm guessing. We'll come back to that. But first, how does someone actually invest in the Dow? You can't just buy the Dow, can you?
No, you can't buy the index directly. The most common route for individual investors is through Dow-based index funds.
Like ETFs or mutual funds.
Exactly. Exchange-traded funds, or ETFs, are very popular. These funds are specifically set up to track the performance of the Dow Jones Industrial Average.
So you buy a share of the fund.
And you're essentially buying a small piece of all 30 companies in the index. It gives you instant diversification across those big U.S. names with a single purchase.
That diversification is definitely appealing. But as I hinted, let's talk about the downsides. You mentioned price weighting. What are the main limitations we need to keep in mind when we see the Dow number reported everywhere?
Well, the most obvious one is just how narrow it is. Only 30 companies.
Yeah, you said that earlier.
Think about it. There are over 5,300 stocks listed just on the NASDAQ and the NYSE. So the Dow 30 represents, well, less than 1% of all those listed companies.
Less than 1%. Okay, that really does put it in perspective.
It certainly does. So while these 30 are big, influential companies, you have to ask if their collective performance truly reflects the entire U.S. economy or the overall stock market on any given day. It might not.
Yeah.
And then there's the price weighting issue we just discussed.
Mm.
Because a high-priced stock has more impact than a low-priced one, the index can be skewed. A huge surge or drop in one or two high-priced stocks can really move the Dow, even if the other 28 are doing something completely different.
Even if that high-priced stock isn't necessarily the most economically significant company in the group.
Precisely. A company with a lower share price, even if it's a giant in terms of revenue or market cap, just has less mathematical influence on the index number. This calculation method, even with the divisor adjustments, leads many analysts to question how reliable it is as a truly representative market gauge.
Okay, so given these points, the narrowness, the price weighting, what do, say, professional investors look at? Do they rely solely on the Dow?
Generally, no. While the Dow is, historically significant and everyone recognizes the name, many professional fund managers and analysts tend to lean more towards broader indices. The most common alternative is the S&P 500.
S&P 500, right. Tracks 500 companies.
Exactly. 500 of the largest U.S. public companies.
Yeah.
So it gives you a much wider view of the market. And critically, the S&P 500 is market cap weighted.
Ah, so the bigger the company's total value, the more influence it has.
Correct. Many feel that's a more accurate reflection of economic reality and overall market trends. Now, it's not like the Dow is completely static. There is a committee that reviews the 30 components periodically and makes changes to try and keep it relevant to the leading sectors.
Mm-hmm.
So, despite its flaws, it's not irrelevant. It still holds that historical weight and is watched closely, but
Yeah.
usually alongside other indicators.
Okay, so let me try and sum this up. The Dow Jones, iconic name, been around forever, tracks 30 major U.S. companies. Key things to remember. It's price-weighted, meaning higher-priced stocks move it more, not market cap-weighted. And it's only 30 stocks, a tiny fraction of the whole U.S. market.
That's a good summary.
So while it gives you a snapshot, it might not be the whole movie. And for a wider picture, people often look at the S&P 500.
That covers it well.
All right, so here's something to chew on as we wrap up. We see the Dow reported constantly. It's this huge benchmark everyone knows. But given that it represents such a small slice of the market, and its movements are driven by stock price rather than overall company size, how much weight should we really give its daily ups and downs? Kind of makes you think, doesn't it? What other ways are there? What other numbers should we maybe be looking at to get a more complete feel for what's truly happening across the U.S. economic landscape?